focus on growth and the rest will follow is a common thing that I think that's very 2019-21 kind of vibe. I think the market was forgiving back then of broken unit economics. I think that the era is definitely over now. Focus on growth and the rest will follow is definitely an overrated goal.
Hello and welcome to the Rule of 40 podcast, a show all about Australia's tech scale-ups, the founders, operators and investors that are building global companies right here at home. I'm Josh Ayscough and with me is Jason Serda. How are you, Jay?
I'm good, man. Very good. Happy to be here.
Great. Today we're getting practical. Growth versus profits, when to push, when to pivot, and what happens when you're coming up to the end of your runway and you're starting to think about a new round of investment or a bridge. So we're going to take you through the framework. We're going to talk about our experiences. I think it'll be a lot of fun. Just to recap, Rule of 40, the basis for our show, it's growth rate plus EBITDA margin. So roughly 40 when you put these two things together. It's a health check. It's not a personality test. It's not a religion. I look at Rule of 40 as a compass. 40 plus, healthy. 20 to 40, probably need some clarity. And under 20, you're in a danger zone. So Jason, I say compass, not a target. What do you think when you talk to founders about Rule of 40?
Yeah, I think part of it is it's instigation of a plan. And I think making sure that you're executing to a plan, and it gives you metrics that kind of keep you between, we often say, when kids go to a bowling alley, how they put those little bumpers up on the side, kind of keep you in the lane. Right. I really feel like that is kind of what we're trying to do and be able to give, our portfolio businesses the best direction. And I think compass is a great word, right, Josh? Like, I think that's the truth is how do you keep them on the path and give them the metrics to understand what that is. Because sometimes metrics can be misleading. People make silly decisions to try and lift numbers. Which is a little bit binary. I think the key thing is just how do you navigate that right direction. You don't want to kill things in process, right? But I've been using a new word. The new word is rubric. What does rubric mean? It's a I guess utility-ism that we came up with that kind of defines how you do things, help you navigate a path. But really, it's a rule set that you can apply the knowledge to try and help you grow from, a low number to this target of Rule of 40, right? Yeah. It is attainable, but no one can do that without a plan, Josh, right? I think
that's right. Like when I think about the compass analogy, early stage businesses and particularly those that are in that, 1 to 20 million phase in the misunderstood middle that we talk about, the path isn't always clear. Scaling a business is hard. Things change over time. The world around you changes. And, the purpose of a compass was always just to make sure that you were generally heading in the right direction. And so if, your intent is to go north and to go towards growth and the compass is pointing backwards and you're going south, then, you're unlikely to ever get there, or it's going to be very, very difficult to get there. So, it's also important to consider that in the context of investment and how you fund your venture, because, it's not just operational time that you lose. It can be your own money or investors' money that you lose in the process as well. And it takes a really tricky time for a business, particularly one that has a good idea and has a good opportunity. So I think what I'd like to do next is kind of bring a few numbers up that are going to help guide the rest of our conversation. So some of the things that, 3 numbers that I think we look at without getting into a finance kind of lecture. Burn multiple, so the amount that you're paying for growth. So under 1.5 times, good. Over 3, concern. If it's more than 3 and rising, you're leaking money. Retention, so net retention rate, NRR. This is the bucket test. Do you have a leaky bucket?
Yeah.
If you're under 100%, you're on a treadmill. We're losing more people than what we're bringing in. Over 110 plus, you've earned the right to start to push. And my favorite, and a thing I look at a lot personally, is payback. How fast do you recover your customer acquisition cost? I've always looked at under 12 months in any business is strong. If you're taking more than 12 months to recover the money that you've spent, unless you're in a business that has really long-term contracts, you're taking a lot of risk.
You know what it is, Josh? I love some numbers, right, to back you up, and you'll love this, right? Like the valuation premiums for companies that are scoring above 40 on the basis of your thinking is a 9.4 times versus a 3.5 times revenue multiple. These are like CB Insights type data reports. So if we can just execute well and follow a plan, you can deliver amazing outcomes. And I think the data doesn't lie. So I think that it's not just an internal compass. It's clear market signals. Like investors are looking at this. Like if we can deliver businesses that have this type of health, if you're above 40 and you're building an amazing business, right? That's the truth.
And I think it intuitively makes sense if you think about a business that is growing really strongly, above 40%, and they're not profitable but they're close to it, or if you have a business that's growing 20% and they're doing 20% to the bottom line, they're inherently good businesses. It makes sense the valuation premiums for them is better.
I'm happy to go below the line as long as you're working to a plan and you're driving a specific outcome, right? Like I think everyone is willing to invest. So I think that, losses at a time are fine as long as you're working to an outcome, and you have a plan that you're executing, call it the rubric. But at the end of the day, the plan should come first. How we fund the plan is a second topic.
I personally feel very lucky. I got to spend time operationally and driving growth in, one, a very good business, but also a good business that was in the market at the right time and at a time that, you could take the growth at all costs mentality.
Yep.
And make no mistake, it was exceptionally fun.
I remember being on the board going, "Are you sure, Josh?
Yeah.
Are you sure?" Right?
So like that, they were great days. But yeah. I mean, I think as we come into 2026 and beyond, I guess the question to you is, are the days of growth at all costs dead? Are they gone?
Yeah, I think they are. And I think part of that is because you really do need to execute well. And I think that back then we were able to wipe away a lot of our sins by future raises, where those future raises are not as easy to get anymore. So at the end of the day, you can't wipe away your sins. So I think you have one crack at this. You got to do it well. And I think that's why I keep coming back to this rubric or this plan and being able to execute on the right plan, right?
Yeah. I think the plan's a good point there, because I think what I hear and what we talk about internally is that by no means is growth dead. Growth should be a top priority for nearly all businesses going through this space, but undisciplined growth is definitely what is.
And using your raising money over time in order to pay for your mistakes can come out very clearly. One of the metrics that we run is, it's on our questionnaire. I refer to the questionnaire, right? All the questions we ask so many ways. But one of those metrics is based on the total amount of money you've raised divided by the total ARR that you operate at is an incredibly telling ratio. And the reason why I say that is because it basically says, for every dollar I give you, how much ARR are you going to deliver me? And I think that you'd be surprised of some of those metrics with some of the businesses, right? It can be, and that shows you how well you execute, how well and how disciplined you are as a leader to run that business through to success.
Yeah. I mean, I'd love to challenge founders out there that are sitting down and thinking, well, how much money have I raised in the past from anyone, individuals or VCs or private equity? How much have I delivered in revenue as a result to that? And then to take the next step and consider, well, how much profit have I delivered in that time, even if it's at a gross profit level as a result of the money invested? Because I think it would be pretty shocking to a few founders.
Even in the previous business that we were referring to, right? That business is now operating in the hundreds of millions in ARR. So at the end of the day, there were proof points that the spending delivered results. But I think there's a lot of people that are operating, spending money without the results. And I think, that these rule of 40 type considerations, your metrics will come out. You'll discover them as part of this process. Yeah.
Yeah, and I think Rule of 40 is very versatile and helpful for businesses. I think, we put a lot of emphasis on the plan. And so you have to have a plan when you're going out for growth. And I think it's important that founders have a consideration for what are the metrics that they're going to get out of executing on the plan. So, I think people thinking about Rule of 40 as a retrospective, we're going to measure at a point of time and see how we're going, would be ill-advised, as opposed to here's our plan to grow over the next 6 or 12 months. And when we do A, we should get B. And so if that's something in growth rate or profit, and that you're aware of the impact this growth is going to have on you, because you don't want to see you just, a little bit of growth and then dipping hard below the line. It's got to be part of a plan. So
many people come to us and we're raising $1 million. I'm like, okay, that's great. Okay, well, how are we spending that $1 million? And they go, you get a bit of a waffle answer in relation to that. But I think part of it is you got to be ready to have those metrics. You do. And at the end of the day, the rule needs to come. The plan needs to come first, rather than just the finger in the air. I want to raise whatever.
Yeah, I think that's important. So have the plan, know the plan's impact on your metrics, and then when the plan is aligning with the metrics and the targets you've got, then you've earned the right to push and go harder, and you'll be in control of your metrics.
I talked about last time the great little business, Josh. We talk about that a lot. These are great businesses that may even be profitable. They're typically not growing very fast. They are a great little business that may be able to build a fantastic lifestyle for the founders, but typically they're businesses that don't pay back to investors at all over time. We all have them in our portfolio. They're the ones that kind of bump along the road. We are not here to invest in great little businesses. Like, those founders need to swing harder. They need to get together a plan, and they need to take responsibility to build something of significance. And I think that's what investors expect when they put money into any businesses. So if you're a great little business today, all I'm going to say to you is you got to swing harder, right? And you got to consider your plan. But yes, investors don't want the great little business. Yeah.
Let's talk about the investor side and what the impact of this plan has. Effectively, when you're raising capital, when founders come to us, we're really stress testing the plan that the founders have come up with, and then the founders' ability and their team's ability to execute on that plan. I'm seeing now, and what I think we're seeing through Utility and our new fund in particular, is people that are coming in and looking to do bridge funding. And I think there's this really interesting concept around bridge funding, and I'm kind of looking at it and going, well, is this a bridge or is this a plank? Are we walking somewhere? Or are we walking off into the water? And in the past, we've used this terminology pretty loosely and not really paid a lot of attention to it. It was just a bridge was around that was usually less capital than what you'd raised previously, and we didn't really interrogate it too much. I really am now. When someone comes in and says we're raising a bridge round, it raises alarm bells for me, and I want to understand why. From your perspective, what do you see?
Yeah, I mean, I think that we sometimes refer to this as a double shuffle. Yeah, I guess the thought process of raising a smaller amount of money in order to get the business ready for a much bigger raise and have a successful metrics in place, it indicates that we're not there at the time of the bridge. We need the money to fund a plan to get to a proper raise, right? Otherwise, the business will heavily dilute. The business may have to do a down round. You are not ready, basically, you're not ready to go for a proper normal or primary round. I think that's part of the challenge.
Yeah, and I think there's a lot of businesses out there that would have raised in the last few years, and whether movements of the market or other things that haven't worked out, they're coming back out to a bridge now. And I think that the difference that you've just described in that double shuffle, which we're very supportive of, is it ultimately aligns to a plan. A double shuffle is because we're clear on where we need to get to with the money that we're raising. I think the concern that I'm seeing now is that there are founders out there that are bringing businesses looking to raise a bridge to try and get to the goals that they'd set to get out of the last amount of money that they raised. And, as investors, we have to ask, what's materially changed in your business or your team that makes you think that if you'd raised $2 million before to get to $2 million of ARR and you're now raising another $500,000 because you're still not at that target, what's happening? Like, why? What if the bridge isn't working for you, and is this a bridge that leads nowhere? Which kind of brings us back to the underlying metrics that are in the business. Is there's a very famous quote and discussion with Jeff Bezos around his Amazon business where investors were piling out of the business. The share price was dropping, day by day, week by week. And he sat there and said, look, I'm not worried because our internal metrics, the ones that we worry about, they were improving all the time.
Yeah.
And I think as you go through that process now, as founders are looking and they're feeling under pressure, if you're raising a round or a bridge round, but your internal metrics aren't right, I think you're going to have a really difficult time. So, if the underlying metrics aren't improving, more capital, I think, amplifies the problem. Right? Putting more money into a leaky bucket, it's harder to wipe away your sins now.
That's true. You end up, you're on the treadmill, Josh.
Yeah.
Basically, you're running really hard, but you're not moving anywhere. And I think that, it's surprising on how many businesses don't have a lot of these things in place. Yeah. Like, I would always know, our net revenue retention.
Yep.
As a metric, it would govern where we're at. If we were churning, and we always used to have very good landing teams in a lot of the businesses. We were very good at landing new logos. I think the challenge is that if you don't have solid retention, the business goes out the back door. Literally, you work so hard to get them in the front door, and then they're going out the back door. And you're going, okay, where the customer's going? And I think that it's interesting though, because that type of thought process, makes me prompt the art of product management. I'm a big fan of product management, as you know. Like, the number of businesses that may be building things that your clients don't necessarily value is incredible. Like, I think you got to really be honest with yourself and leverage product science in order to make sure you're building the right things, to make sure that you're delivering enough value for your clients. Because if you are churning clients out the back door, you've got to ask yourself why. And that should be something, because it just nails you, right? It just nails you.
And I think, encourage founders to be as transparent as they can with investors coming in about what's worked, what hasn't worked, why they are where they are in their funding journey. Because I think as you're coming in and you're thinking about a bridge or your next round where you maybe haven't executed to the point that you would like to, you need to start thinking about, whether you do a flat or a down round, what the structuring of that raise is going to be. I know, Jay, when we've looked at a few businesses that have come to raise a bridge, we've looked at employing structures like a ratchet that allows a business to, simply be valued on, a multiple or some other metric in line with their forecast. Hit your numbers and get the number that you want, exceed your numbers, and by all means, we're happy to pay a higher valuation for that business. Miss your numbers and have the valuation go down. Yeah. I mean, I don't know it's been appreciated by everyone, but certainly those founders who are comfortable with their plan and have a strong plan and believe they're going to hit their numbers don't shy away from structure like that.
Yeah, I think you got to be careful, right? Like, investors, especially VC investors, they're clever people, right? So, it's very hard if you overestimate what you think you're going to be able to achieve and you're unrealistic in your thought process there. These type of mechanisms can be punitive. I mean, a clever pref share at a multiple pref can wipe out a founder's equity if you don't, you don't make the right decisions there. So I think part of that is, don't assume the investor is silly. Right, either, right, and I think that's why rule of 40 style discipline can make all the difference, because you're thinking about those things, you're operating to a plan, you're considering the metrics, right? And I think that medium NRR across B2B SaaS businesses in 2025, like they're compressing from prior highs. Yeah. So at exactly 100%, you're replacing churn dollar for dollar, right? So one bad quarter and you're back on the treadmill again, Josh, right? And there's validated data that says that, right? So look, 101% is not necessarily a bad number in isolation, but it can be in a precarious position, right? So one customer loss, one pricing misstep, and you're below the waterline, right? And that's not a foundation to accelerate from.
And one of the things you said there, which I think is really important, is in isolation. I think this concept of growth at all costs is dead, is a call to action to consider all the metrics in your business that really matter as you're going through your growth phase, and being able to look and see those metrics and how they're performing in the context of your other metrics. NRR is a really important metric, and under 100, 100, 101, 150 are all really interesting.
Yeah.
Right. When we were going through previous businesses, we talked about this context of bikini statistics. Right. What they revealed was kind of interesting. What they hid was really, really important. And so, when you think about your growth journey and you're watching these metrics, things that are really interesting to me are, where certain metrics that you're targeting, your plan, you're intentionally trying to grow, are having a positive impact. We want to grow our revenue, right? Is revenue growing up? Yes. That's fantastic. That's intentional growth. If every other metric is holding flat and it's the same, I'm seeing that as a big win, right? You're not losing something by accident. If growth goes up and profit goes through the floor, right, we've got a problem and you're not in control of that metric. And sometimes there's happy accidents. Sometimes, you can just get growth or good customers, and a bunch of metrics are going up.
Luck does happen sometimes.
Luck does
happen sometimes. But in the longer term, it's not the whole plan, right?
Absolutely. Yeah. And so I think, again, this concept of growth at all costs is dead. Growth is still important. Intentional growth is important. The other thing that you began to talk about there was, I guess, investors in general, where they're smart people. Right? They've been there before in a lot of cases, particularly your early stage investors. They like being operational. They like understanding a business and its metrics. So investors love seeing metrics and that you've got a kind of control room behind you and that you're watching. It gives you a lot of confidence as an investor that the money is going to be spent because unintentional has the potential to be wasted.
Spend it like it's your own.
We're realistic that things are going to happen. Things won't always work the way they plan. Like, that's just life. And I think it's also important to note at this point, because we've talked a lot around these guardrails and how we kind of a focus on these guardrails. Investors and utility in particular, we're not trying to punish ambition. We want ambitious founders. We want founders with big, lofty goals and a plan to create really big and meaningful businesses that are going to have big impact on the way that we work and live. So we don't want to punish that ambition, and I don't also want to see a highly conservative, very small growth budget, because that won't help you either.
Yes.
What we're talking about is, punishing or looking at and controlling execution.
Yeah. And I think these metrics indicate to a educated investor that it's also about the people and the systems and the company that you've put together, that you can execute well, and that you have an engine that's going to execute with growth, and you can drive their dollars very far, And I think this is also applying is being amplified now in the new AI first world. So, there's a lot of efficiency coming through AI that is playing a role here as well. So, I think it is evolving, the way that we're doing things and applying this thought process around rule of 40.
So let's do our quick fire 3. With that last episode, I really liked it. So let's do it again.
Yeah.
Question 1. Okay. What metric is being overlooked by founders today?
I think the direction is burn multiple, right? Not at a level, I guess that's the key. Everyone reports on the number, but few people track whether it's improving or deteriorating on a quarter-by-quarter basis. And so a burn multiple of 2.5, that's been 3.8, then 3.1, 2.5, is completely different business than the one that's been 1.8 or 2.1 or 2.5. So same number, totally different story, right? So, I mean, you can tell so much stuff from something like that, Josh, yeah? And, you know, I feel like a little bit of guidance with founders to kind of open their eyes around the art of the possible just gives them the ability to pivot and navigate and make decisions and kind of balance, do I go or do I not go, and the tolerances in which you need to do. So, you know, as an example.
I think for me, it's always customer acquisition cost, but a fully loaded customer acquisition cost. So I think that there's various different views on what's included in a customer acquisition cost. It's okay if you've got a particular view or one that you've stuck with for your investors or what you take out to market. I encourage everyone to have a look at a fully loaded customer acquisition cost that includes your marketing team as well as its spend, includes any discounting that you're doing. Because when you start taking in a fully loaded customer acquisition cost and you use that to determine your payback period that I spoke about before, it inevitably extends the payback period. You look on an advertising spend alone, we might have a payback period of 9 months, but when you consider the team that's responsible for driving that marketing engine, and if you consider that your salesperson's offered a 50% discount on your first year of the contract, you could be dramatically extending your payback period to a point that, you know, to your NRR point, if the churn becomes a problem in the future, you can have a real business problem. You can begin losing money on customers, and particularly in businesses that in the early days maybe don't have the scale profits that they're wanting to get to. So question 2, overrated advice for founders. I'll go first. I think a lot of founders in those that particularly are doing enterprise sales or have a big sales process and they're in that misunderstood middle, they're still working things out. You know, these metrics aren't stable yet. You know, they're not expected to be. Is to go and hire the big name salesperson, go to market, the person who looks like they've been there and done that before. They've run the big teams, they've hit the big targets, and you know, those people, there are those out there that want to go back into the early stage business and be part of that. I haven't had and seen success with that model because I think it's very different building a growth engine to running a growth engine. I think there are people out there that are exceptional at running a growth engine. Building a growth engine and working it out and being able to pivot and look at these metrics and interpret what's real, what's not real, is a skill set that fewer people have. And you have to go looking for that person that can build the engine for you.
I think the businesses will struggle to scale beyond a certain point because they're based on good people rather than systematic or the engine as you referred to it, Josh. I think that's so true. You actually need to have both, right? You need to have the engine operating around good people, and then you need to be able to scale those operations. But I think that's go-to-market execution, engine and whatnot. And a lot of founders, I think, struggle to move beyond founder-based sales. Really what that means is there's one rainmaker, he knows the business better than anyone. He's out there selling and selling very well. But when you get the second guy or the third guy, you know, they find it very hard. What ends up happening is sometimes those SDRs is all they do is end up paying for themselves. They don't really drive most of the sales, and the founder is still the one that's bringing in the lion's share, or the rainmaker, so to speak. But I think that is definitely true, right? I think that is hard, and a lot of founders need help with that. It's not an easy process. But you know, one of the other thinking was focus on growth and the rest will follow is a common thing that also I think that's very 2019-21 kind of vibe. I think the market was forgiving back then of broken unit economics. Yeah, I think that's true. And if the top line was impressive, they would kind of give you a leave pass. I think that the era is definitely over now. I think the rest... you know, like I think you need to build it intentionally, and I think that in parallel with growth from day one. right? I think that's kind of my takeaway now. You just can't overlook that. So, focus on growth and the rest will follow is definitely an overrated goal. Yeah.
And so if you could encourage founders to look at one thing tomorrow, what would you get them to look at?
Oh, okay. Look, I think that if you can apply a rubric that puts you as the child at the bowling alley, and that we can apply some bumpers that helps you execute and give you the rules of how you operate, and that you surround that with the right metrics that allows you to deliver Rule of 40 style businesses, I think you will do tremendously well. And I think we refer back to the goal that we talked about the multiples that are being driven by high growth and or profitable businesses that fall into this metric. I honestly believe you will knock it out of the ballpark. And I think in today's market, when you don't have second or third chances to raise money and wipe away your sins, I think it could be one of the most compelling ways to help you operate your business. Swing, don't be a great little business. And I think if you apply some of these lessons, you will do so well. So, such an opportunity.
I couldn't pick through to two things. So the one I'd originally put ahead of today was to go back and look at your last 5 deals. What was the last 5 deals that you closed?
Yeah.
What was the makeup of those deals? How did they come to you? How long did they take to close? Go look at in depth how those last 5 deals performed and whether you think that they are reflective of the business that you want to be. What are you unhappy with? What are you really happy with? What would you do differently on the basis of that information? The second thing, and I did this a lot in the past, was vintage analysis. So if you take a 5 deals approach, look at your last 5 deals. You or have someone else in your team pick 5 deals at random from the previous month and go back as far as you think is useful and start seeing what's different and start seeing if we're getting better. Are things improving? So you might say to yourself, this deal, last 5 deals took 6 months on average to close. You might want them closed in 3. That's fine. You've got a goal and you're moving forward. But if 12 months ago your deals were taking 9 or 12 months to close, then at least you've got positive movement in your metrics. The same may not be true. It took previously 6 months to close and now they're taking 3. Again, good in isolation, but what else is happening in those deals? Because I've seen...
You learn so much, right?
You learn so much. I've also seen a lot of founders in particular be surprised when they're looking at certain metrics consistently, how good people are at bringing them the numbers that they want to see. And so there's a business that we've worked with in the past that I went looking through their deals and what's closed. And what I was told by the founder was, look how great we're going. We've reduced our time to close deals by 100%.
Right.
That's incredible. How great to go from a long sales cycle to a significantly shorter sales cycle. Fantastic. But what was hidden in that data was that discounting had also gone through the roof. So to quicken the sales cycle, to hit numbers, because what was important was contracts signed and time to close, we ended up with discounting that meant the payback period was extended to double. So in essence, we're no better off as a business, and we're just adding more risk because we've spent the money, we've paid the commissions, and if they were to take their option to leave after 12 months in their contract, the business is going to be losing money. It's a real concern.
Sometimes people like to present metrics to drive their agenda. I think that's why you need to give them a well-rounded approach to that, right? To your point about going back to, total cost of acquisition and being able to calculate it appropriately. I want to go back to one of your other points, Josh, around, I've always been a big fan of ringing clients that have churned. I believe that you need to kind of fix the leaky bucket first before you go off and do other things. And I think that one of the things is I as a board member and sitting on a number of boards, I always volunteer to actually call churned clients. I think that you get an incredible amount of information out of that to try and understand why and learn from it and make sure we're also aligning our value proposition. Are we delivering enough value? Going back to my product management comments earlier, I think that you can learn so much from that. in really understanding where your clients are, and are you really adding the value? Sometimes founders can be in the illusion that they're delivering value, and they'll say to me, "Oh, our portal's next level, and have a look at this, Jason." And I look, and it's an impressive portal. And then my follow-on question would be, can I see the login statistics associated with how many people are logging into it every month? And you start to see that not many people are using it, and you go, well, are we really delivering the value that we think we are? But your churned clients actually really, really appreciate the phone call and give you some really insightful insights to what value is and isn't. So I think that's so true.
Yeah, I think there's places out there now you can get the help as a founder, or people that are going through this misunderstood middle phase to understand and get validation of the metrics that matter. So I think if founders can take kind of one thing away from today, I think if you take Rule of 40, as a compass, and you apply your rubric concept, Jay, you can pick some metrics that sit broadly into the categories of growth and profits. We don't have to overcomplicate business. These metrics can become very complex and a very long list very quickly.
Yes.
But growth and profit as a base, and then within your rubric, pick the metrics that matter within those that relate to your business.
Absolutely.
And then apply simple weighting. In this moment, what are we aiming to influence? If you think about it, and number of boxes, here's growth, here's profit. Put 3 metrics under each of them, so you end up with 6. Ideally, we want to see everything improve, but in terms of your plan and your intention, which 2 or 3 of these metrics are you aiming to improve, and where do you want them to get to?
Yes.
And weight them accordingly, and then look at the whole picture from there to see, are we getting better? Is there anything happening that we weren't expecting? And then, go and adjust the plan accordingly.
We have the dashboards as well that can surface the information up. This doesn't need to be onerous either, right?
No.
Like at the end of the day, you try and make it easy and make it accessible, and again, it's I'm telling you, it's like the best analogy is the kids at the bowling alley with the bumpers up on the side. Come on, right?
I think
it's so true.
Some of these things, at its furthest level, it could be life or death for a business. And if getting the metrics that matter are onerous for you and too onerous for you to go and get, then I think founders have got a much bigger problem in those businesses. If you ignore your metrics and things like burn multiple, retention, and payback period for long enough, it has the potential to dramatically impact your business. Or at very least, it is going to impact your cap table. If you're thinking about raising now or in the near future, I think these are metrics and things that you need to be looking very hard at.
And you remember, if you have a look at the statistics as well around the length of time now between raises, there is a huge number of businesses out there that haven't raised since 2023. In addition to that, there are a large number of businesses that have obviously raised at very high vals during that period, right, as we know, and are now facing considerations around down rounds and all of that, Josh. I think that that's definitely a consideration. You look at some of the biggest businesses out there. Chime in the US IPO at 25 billion at its peak, and IPO'd at 9.8 billion, right? I mean, that's a very extreme example, but I think that is, there are some indications now where businesses are trying to navigate that as well, which is very challenging. And I think that there are ways of doing that. I think at the end of the day, you can't ignore that either, right? Some businesses try and avoid the future raises, but you've got to acknowledge when you've raised at mega high vals or overpriced yourself.
Yeah, and there's no right or wrong in the past. We can't go back in time, but price has an inherent ego component to it. No one wants to do a down round. It doesn't look good to do a down round, but if you have a plan and you have the guardrails in place and you're very clear on where your plan is going to get you, and that you can see a path to make up that delta, then I think it's less of an issue. You know, if you
Yep.
still don't have the plan in place, you know, a down round is going to be more than just an ego hit for a founder. It's going to be, you know, very meaningful to their end outcome. But
Yep.
you know, this is the point you're at. That's it for today. If you found this useful, we're going to have more podcasts coming out over the coming weeks and months.
And some amazing people are going to be joining us, guys. We've got some amazing people coming up. So please check back with us, right? We're really eager to get some amazing people out here to give us some insights and be able to challenge assumptions rather than just Josh and I chatting away as we love to do, but, you know, get some stellar companies to represent us here and allow us to have some amazing chats.
Wonderful. All right. Well, this has been Jason and Josh on Rule of 40, and we'll see you next time.
See you guys. Bye.